Hi, good evening everyone, and thank you for inviting me here today to talk about the recent legislation that was passed at the end of last year in Washington. And that's what we're going to talk about tonight, a review of the Tax Cuts and Jobs Act of 2017, also known as H.R. 1, also known as the Bleeping of America. So let's first talk about the bill. It's the bill overall itself. Now, first of all, this bill was first introduced into the House of Representatives on November 2nd. 2 weeks later, it passed. 12 days later, it was introduced into the Senate, passed about a month later. Why did it take longer to pass into the Senate? Well, first of all, they had the Thanksgiving recess. And then, of course, once they came back, they had to deal with the potential shutdown of the government. As we know, Congress has not passed a budget in years. What they keep passing are what's known as CRs, or continuing resolutions, which allow the government to continue to operate. So now, during this time, there were no debates. There were no hearings. There was no testimony from anybody outside of Congress. In fact, in the Senate, you had Mr. McConnell, the Senate Majority Leader, saying, we have to pass the bill to know what's in it, which is very reminiscent of what Ms. Pelosi said 8 years ago regarding the Affordable Care Act. Basically, she said the same thing. We have to pass the bill to know what's in it. Same thing here, and because, as everybody may remember in the news, they were busy writing, scribbling on pieces of the legislation, putting in things, taking things out. The final bill is only 185 pages long. But still, there's a lot in it, and even we in the tax profession of people who prepare returns, there are still some things that we are still trying to get our heads around. There are still issues that we're waiting for Congress, waiting for the IRS to come out with guidelines and regulations so that we know exactly what's going to be happening. And this bill was signed in on December 22nd. Now, originally, they were going to have this big ceremony right after New Year's, but of course, as we all know, President Trump promised everybody a big Christmas present, so he had to sign the bill in the Oval Office with no fanfare, just a few cameras, a few photographers, signed the bill, so it was into law before the end of the year. So the impact of this bill. Now, there are corporate tax changes. These changes are now permanent. They will not be, unless Congress passes a new tax bill, these changes are the changes, and that's it. As for the changes regarding individual taxpayers, those are only good through 2025. But as I said, this is only for now, because who knows what will happen in a future Congress, whether it is the Congress that takes office come next January, or will it be the Congress in 2021 after the next national election and electing or re-electing a president? So with regard to the corporate tax changes, right now, through tax returns for 2017, there are these multiple tax brackets. It's 15% on the first 50,000, 25% on the next 25,000, 34% on the next 25, 39% on the next 25,000, and so forth, as we see here the various brackets. With the new bill, starting with corporate returns, starting in 2018, there's only one rate. It's a flat 21%. Now, this regards C corporations. Corporations that file an 1120 return. 21%. So if you have a corporation and you were trying to get down into the 15% bracket, well, it doesn't matter anymore. It's going to be 21%, whether you have a $2 million profit or a $20,000 profit. Okay, now since we're talking about real estate, there is depreciation. Now, is everybody here familiar with Section 179 of the Code?
No, because I don't.
Okay. Well, Section 179, depreciation Section 179 of the Internal Revenue Code allows you that that if you buy something and it qualifies under Section 179, instead of writing it off over the quote-unquote useful life, you may write it off in its entirety in the first year, the year you buy it, the year you place it into service.
Okay.
and you can write it off. Now, what they've done is they've raised the limitations on this, that up to $1 million of equipment, of assets that you buy that qualify can be written off in the first year, and the threshold has been raised from $2 million to $2.5 million. That's the total amount that you can buy in a given year. Once you go above that, the amount that you can take under Section 179 starts to get reduced. And now, under this bill, qualified real property, which falls under Section 1245 of the Code, is also now allowed to be subjugated under Section 179, and that includes roofs, AC systems, fire and alarm systems, security systems, to name a few. Yes, Michelle?
So like if we have someone that buys an LLC, this pertains to them?
I mean,
Buying
buys a building.
Right.
Yes.
In an LLC,
An LLC, well, in any entity.
in any entity, okay.
Yes, it doesn't matter whether it's an S, a C, an LLC, a partnership.
Okay.
This is allowed for everyone.
Okay.
Okay. Now, there's also something new also here, cost recovery. This is very similar to Section 179. This is what's known as the bonus depreciation, where you can write off, again, you can write off the purchase of equipment placed in service in the first year.
Okay.
And this does not fall under Section 179, so it's like regular depreciation, but it's just extremely accelerated. Now, you can do 100% for anything bought after September 27th of last year through 2022. And then in the succeeding years, it goes down by 20%. In 2023, you're only allowed 80%, 60% in 24, 40% in 25, 20% in 26, and after that, it's gone under the current. Remember, everything is under current tax law.
And this is to encourage spending?
This is to encourage people to purchase. But remember, one thing you have to be aware of, and this is something you should always be talking with your CPA or whoever you use to prepare your returns, is that should you do this? Because remember, how are you buying the equipment? How you whatever you're going to expense out, how are you paying for it? If you're paying cash for it, well, that's fine. You can do it. But most people do not pay cash.
Right.
Most people will put some down and they will finance. Now remember, with the financing, you're paying back interest and principal. And remember, interest is deductible, principal of a loan is not deductible. So that's where depreciation comes into play. Depreciation is a non-cash deduction and can be used to offset the cash that's going out to repay the principal of a loan. So this is something that should be discussed every year whenever you buy equipment or any property, whether you can do it, and more importantly, whether you should do it. That's what you have to be aware. Should you do it? Just because you can doesn't mean you should.
Right.
Moving along. Now, businesses can sometimes have a loss, and a net operating loss. And up until this bill, you were allowed to take that loss, and you could carry it back for a couple of years, 2 years you had profits. Well, you can't carry it back anymore. It can only be carried forward now. It used to be carry back 2, carry forward 15. If it wasn't used in the 15 years, it was lost. But under this, it's just you would lose the 2% 2 years of carry back, but now you can carry it forward until it's used up.
Okay.
So, meals and entertainment. This is something very important. Who here buys tickets? Who here? Michelle, do you buy Marlins tickets to give it out to clients? Know anybody who does that?
Not allowed to.
But a lot of companies, they will buy.
Yeah.
They have a box at
Like
the
all my
ballpark,
sons.
right? Or all my sons. Okay, well, guess what? Entertainment is no longer allowed.
Oh, that's not good.
Entertainment, not meals. Entertainment. So if you buy those tickets and give them to clients, can't take it as a deduction anymore.
But
Just
meals we
goodwill.
can.
But meals are still allowed, still subject to the 50%. But those baseball tickets, those theater tickets, giving clients to see a show at the Kravitz Center or the Broward Center in Fort Lauderdale,
That's good.
that is gone.
What about martinis?
That's meals and entertainment. Meals are still allowed, but entertainment is not. And regarding meals,
That's interesting.
You're saying you cannot expense a ticket now? You can't run it through your business account? Is that really what you're saying?
yeah, you cannot. If you buy tickets to the Marlins and you take a client to that,
Right.
you cannot deduct it.
Has to come out of your personal.
Well, it can, so the business can pay for it, but it's like officers, a few other things, officers' life insurance, or the or the other half of meals and entertainment that you have to add back. It's an add back for tax purposes.
Okay, I get it. You can. Yeah.
You can still do it, you just can't deduct it.
Right.
That is the problem. Meals are still allowed at 50%, but now this also includes cafeteria plans or meals that you have on the premises of the employer. So if you bring in the meals for the employees so that everybody can keep working, and you bring in the 6-foot deli sandwich, that's still allowed. Yes, Michelle?
But at 100% or the 50%?
No, still 50%. Meals are still 50%, but now it includes also meals for employees. So you just can't just write it off as, say, an office expense, which we used to do, but now you can't. Okay, fringe benefits. I know this doesn't get a lot of play in Florida, but still, let's go over these. Transportation expenses. You know, a lot of companies do provide transportation, like especially up in New York. They used to have these, buy these discounted MTA cards or Long Island Railroad, and give that to the employees at discounts. That's gone. But commuting equivalents are repealed between the home and workplace, but unless it's a safety concern. So for example, you have an employee who has to stay late at work to finish something, and you're here and they first get done at 7 o'clock. And you say, well, I don't feel safe allowing you to just walk over, take the subway, or get to the train station. We're going to call a car service, and they will take you to Penn Station or wherever. That's still allowed. That is still allowed, but otherwise it's not. I know that doesn't... Okay? Business interest. Now, this is something for high-end companies. This is something that did not get a lot of play in the news. Interest, that's interest on loans, is limited to 30% of the adjusted taxable income. So what you have basically is you get your book profit, then you have your various add backs, officers' life insurance, 50% of meals and so forth. You also have to add back the interest. What is the profit then? Then you only are allowed to take up to 30% of that. But that is only for large companies. Now, whatever is disallowed is allowed to be carried forward, so it can be used in future years. You don't lose it and it's gone. It's kept there in suspense until such time that you can use it. Now, certain businesses, certain industries are exempt from this. For example, real property, construction, farms, those are all exempt from this. But remember, it's for businesses with an average gross receipt of up over $25 million. So most small businesses will still be allowed to deduct their interest in full on their lines of credit, on their construction loans, on their bridge loans. The interest there will still be fully deductible so long as they don't exceed $25 million in gross receipts. And the interest expense is determined at the tax filer level. That's important to know. Remember, with the C Corp, the C Corporation pays income tax. An S Corp, a partnership, an LLC, that all passes through to the individual shareholders, partners, members, and it's determined at their personal tax level. And the same thing, so that also applies with the pass-through entities, the S Corps, the partnerships. Now let's talk about individuals, which really affects more people, will affect more people more so. So, tax brackets. As we can see in 17, we had 7 tax brackets. Now, when this bill was originally being discussed in the House, they wanted to reduce this to 4 brackets. Final result is we still have 7 brackets, but as we can see that some of the brackets have been slightly reduced. The 15 is now a 12% bracket, the 25% bracket is 22, 28 is now 24.
The 12 is 50,000?
No, well, again, it's still, well, though, no, you have to look at the actual the tables,
Okay.
which I do not have on this PowerPoint,
Okay.
because remember, it's our tax system is what's known as a graduated tax system. So, for example, if 10% up to, so for example, 10% up to $20,000. So you're paying 10% of up to $20,000. You get to the next bracket, which is going to be 12%. You will pay 10% on the first 20, but 12% on anything over 20 and up to whatever that bracket ends at. So it's a graduated scale.
That's good. When are you hitting that 37%?
You got to be way up there. That's mid 6 figures, like around $500,000-$600,000. No, when you talk with your tax preparer,
Yeah.
we all have dreams, Rebecca. But it would be nice, yes.
I want to have that problem.
True story, had a client passed away a few years ago, a psychiatrist who didn't practice, went into real estate, owned properties in Manhattan. Once said to me, I have no problem paying my fair share of taxes. I just wish everybody else would too. And that's part of the problem with this country, but that's another story.
Is this on, oh, sorry.
All right, go ahead.
Is this on people like us that,
The 10, 12, 20, that's on all of us, yes, on our personal income tax returns.
okay, but I'm saying because we're 1099.
Yes, that goes on. Remember, you get it. That's still, this will affect you because,
I always cut a little bit and I put it in the bank. And then every quarter I,
well, you have you have an S corp, right? And you draw a salary from there, correct?
I pay gross.
But you have a subchapter S corporation. Okay, so your corporation gets paid. You draw a salary, which is an expense of that.
Yes.
And then whatever's left over after your salary, the taxes, and every other expense, that is your profit. You get a K-1 form from that, which is part of what goes on to your personal income tax return. Your K-1, your W-2 for an S corporation is your income.
I'm just saying, I don't, we don't have to get into it.
Okay.
It's a gross amount.
It's on your-
I don't pay taxes out of that.
No, you pay taxes out of your salary. You have withholdings.
No, I don't have any payroll. That's what I'm saying.
You're an S corporation or you're a Schedule C. How do you file your return? How do you report your income? That is really the question. How are you? But these brackets affect whether you have an S corp,
Right.
whether you have a partnership, whether you have a W-2 or not.
I cut 15%, so I'm trying to figure out how I'm doing it right.
Well, you really need to have things reviewed to know if you're doing it right or not.
Well, he hasn't complained.
Okay, now the standard deductions. Now this is what's being changed from 17 to 18. As we can see, if you're a single individual, your standard deduction this year is $6,350, but next year it's going up to $12,000. For a married filing joint return, it's double. For a head of household, it's roughly halfway between the single and the married couple filing jointly.
And who would be head of household?
Head of household is anyone who is not married but has dependents. So, for example, a widow or a divorcee with
What about
minor
an
children.
elderly parent?
Or even if you're claiming them as a dependent, yes. Remember, the rule regarding claiming someone as a dependent is that you must provide more than 50% of their support. So if mom is living with you and has very little income, say outside of Social Security, then you could possibly claim her as a dependent. Each case is individual. It has to be looked at to see whether or not that can be done. But now here's the thing that they didn't talk about. This did not get a lot of play. Not this about now if you're over 65 or you're blind, they do allow additional deductions to the standard deduction. That's going to be gone, but here's the thing that's really important. Exemptions. For 2017, it's still $4,050 per person, taxpayer, spouse, and dependents being claimed. In 2018, that is gone. Basically, they supersized the standard deduction. They got rid of the exemption. That's how they did it.
What was the difference?
What's the difference? Married? No. Kids? Okay. Well, if you know somebody who's married and has several, and they're filing jointly, and let's say they have 4 kids. Under 2017, in addition to their standard or itemized deduction, which they also get to take the exemptions. $4,050 times 6 is $24,300. Now, let's say for argument's sakes, this year, in 2018, they didn't have enough to itemize. Well, married joint, they're going to get the $24,000. No exemptions. All they get is the $24,000. That's it. So, even if with taking the standard deduction, if they were that, they're losing, say, for at least that $12,700 in the standard deduction. If they own a house and they have the mortgage interest and the property taxes, and they make charitable contributions, they might still be in the $24,000 range, and that might be well and good, but then they're going to lose all their exemptions on top of that. So they will have a higher taxable income. So here's an example of that. We take a single individual who gets paid $1,600 weekly, $41,600 annually, comparing 17 versus 18. So let's say that's their only income, $41,600. We take the standard deduction, the exemption, and that's their taxable income from 17 versus 18. And as we can see that in 2018, because the standard deduction is greater than the standard and the exemption combined, they have slightly lower taxable income. That's fine. One other thing that made the news, and maybe most people didn't recognize it, but they're seeing it in their paychecks now, is they changed the withholding tables. How much has to be withheld, so people are taking home more money during the year. Okay? Right, they're taking home more. So in this case, this person, if you look at the tables, their tax liability went down by about $1,000, a little bit more than that. With the new withholdings, their withholdings went down by about $1,000 also, a little bit more than that. Net result, they're getting back a smaller refund. Now the thing is, people want those refunds. That refund that they get at this time of year, everybody knows about it. It's already spent. They have it earmarked for something. Whether it's paying the holiday bills, the down payment on the home improvement, the new car, the vacation, the summer camp for kids, or that's what we're going to put into savings. They've already got that money spent in one way, shape, or form. It's already there, it's being used, but now they're going to take home less. So really, the impact is not going to be felt on all of this until this time next year. That's when people will see what happens. Yes, they'll have more money in their pocket during the year with their weekly, bi-weekly pay. No, they're not going to save it. We have still very little savings in this country. Most people with their take-home pay, their quote-unquote disposable income, it's disposed. They don't put money away. People do not have the discipline to save. And that's what happens, and that is a sad thing. Because you cannot rely on Social Security. You cannot rely on a 401k or an IRA as that's all you're putting away. One thing I ask clients all the time is, when the time comes when what you've got is what you've got, when you're retiring, what do you want to do then that you didn't do now? What are you putting off till then? When you're young and you're getting married, you're having fun, you start a family, your vacations are children-oriented. You go to Disney, you go to Hershey Park, Pennsylvania. You go on where the kids have fun. When you get a little bit older, maybe you go, away for a week, go to a nice resort where the kids want to just hang out by the pool or by the beach. But then when they're gone, when you're empty nesters, what do you want to do then? Well, we were planning on that 3-week cruise to the South Pacific. How are you going to be able to afford it? You have to have the discipline to save. And I don't care how you do it, but you got to, even if you start small, I tell this to clients all the time, start small. You sit down twice a month and pay bills. You have your first of the month bills, your rent, your mortgage, your HOA fees, whatever else. Then you have other bills that you pay, say, middle of the month. When you sit down and pay those bills, make a payment to yourself. I don't care how you start, $5 or $10, whatever, but you have to get into the habit of doing it. That's what's important. And then as you have more money, you put more money into it. And you'd be amazed at how quickly that can grow. Especially once you get other obligations paid off and you can put more into there. The child tax credit, okay, for 2017 it's still $1,000. Next year, it's going to be up to $2,000. Now, this is something that will help some people, but if you're getting a refund, only $1,400, that's is a max refund. You're not going to get back the full $2,000. And then for any other dependent you claim who's not a qualifying child, you will get an extra $500. And here's the thing. This goes up to anybody up to $400,000 or $200,000 if you're single. So the phase out begins a lot higher up. So that will help some people. Deductions. Medical deductions have been reduced back to 7.5% threshold, and that's 7.5% of your adjusted gross income. You have to reduce your medical expenses by that. So for example, if your adjusted gross income is $100,000, 7.5% is $7,500. You don't get that. It's anything above that, assuming you have the ability to itemize. Taxes, this is the thing that made the news everywhere. Taxes are limited to $10,000. Now here in Florida, we do not have a state income tax, but there are some parts of Florida where the property taxes are greater than $10,000. Well, all they're going to get is $10,000 altogether. That's it.
So everyone that lives in New Jersey is trying to sell their house.
New Jersey, New York, California, Illinois, any state that has a high income and or property tax rates.
They'll be coming here.
Possibly.
Good for us.
But of course, they have to have the ability to sell their house up there. Now, we know that some of the states are have threatened legal action against the federal government. Some of the states are looking at other ways that they can help their residents still get the full benefit of all of their taxes. We recall in the news that a lot of people in the high state tax rate, that they were trying to pay property taxes early. And the IRS says, yes, you can do that, provided you know what the bill is. You just can't go to the state and say, here's $20,000. You have to have a bill or an assessment to be able to do that. A number of our clients at our firm, we still have clients up in New York and all over the country. A few were able to do that, but we will see what happens because unfortunately, is everybody here familiar with AMT, Alternative Minimum Tax? Well, with the AMT, it's another way of computing your tax liability. And what it is you take your taxable income, you lose your exemptions, which will be moot next year, but then you add back certain itemized deductions. And the first one that you add back are state taxes paid. Doesn't matter whether it's property or income taxes withheld. Whatever you paid in isn't another issue that is added back. And a whole part of the formula to determine whether or not you have a different tax rate. And with the AMT, if your AMT tax rate is higher than your computation under the ordinary rates, that difference you pay is called the AMT, is your AMT. Charitable contributions. You've always been allowed to take up to 50% of your adjusted gross income. Well, starting next year, it will be 60%. Again, anything you take in excess of that, you do not lose, is carried forward for up to 5 years. And then also with the charitable contributions, buying seating rights at university athletic arenas, stadiums, that's now been repealed. So you cannot take that as a donation. Yes. If you like buying a personal seat license at FAU Stadium or wherever.
But that charitable contribution, that's 60% of what you do.
Of your adjusted gross income. So again, if your adjusted gross income is $100,000, you could donate, in 2017, you could take $50,000 of charitable donations as a deduction. In 18, you can take up to $60,000. Anything above that gets carried forward and can be used in future years.
Okay.
Okay, mortgage interest. The house, remember, under the current law, the law prior to this year, it was up to $1.1 million. $1 million on a mortgage and $100,000 on a HELOC, home equity line of credit. The House wanted to reduce it to $500,000. Well, they compromised, they met in the middle, so $750,000 of mortgage indebtedness. But that is only on new mortgages. If you already had a mortgage, that's greater, it's grandfathered in. So if you still have $1 million mortgage, you can take all the interest on it still. That is a law, you can still take that and deduct that. But new mortgages, $750,000. Even if you refinance your existing mortgage, because it was a previously existing mortgage, you still get the full amount.
Damn, we should have bought that house we shot.
Okay. Home equities. Home equities are no longer deductible. However, and the IRS just came out with this, the home equity line of credit, assuming you are still under the threshold, is deductible providing that the home equity line was used specifically for home improvements. So if you use it, if you got a home equity line of credit and you use it to consolidate your debt, no. But if you use it to do it, but like I said, if you use it to do your kitchen, to put an extension on the house, so grandma has a little, Well, that's a home equity, that's using for the home, or you bought that little extension to put above the garage so mom has her own little private apartment. That you're still allowed to take. That's still good. Anybody here getting divorced or know somebody get in the process of getting divorced?
Not yet.
Not yet, but here's the thing you need to know about. Here's the thing you need to know. As those who have been divorced are aware, alimony is a deduction for the payer. They get to take it as a page 1 adjustment, and the recipient, the ex-spouse, has to pick it up as income. Well, if you know anyone who's planning on a divorce, tell them they better finish it before the year is out.
Okay.
Because starting next year, any divorce or separation agreement is non-deductible by the payer. Consequently, the recipient does not have to pick it up as income anymore.
Wow.
So it's still going to be taxed, but remember, the person who's paying it has the much higher income.
Yeah.
Therefore, they're going to have to pay tax on that money. So if they're paying $5,000 a month, they used to be able to deduct that $60,000.
Not grandfather.
No, that's great. If it's still existing, it's allowed. But anything new, a new divorce agreement, a new separation agreement that goes into effect starting in 19. So if you know anybody who's ending their marriage, you better tell them to do it quickly. This will have a big impact on divorce settlements.
Yeah. Hurry up.
Whether it is the belligerent one or the more friendlier one known as a mediation. Either way, this is going to have an effect on that. Now, here's something that we all need to know about. Now, this is something that's very new. Section 199A deduction. This is something that some of you may have heard about in the news or not. It's the qualified business income deduction. Some think this is the biggest change in the code since '86 when we had the big Reform Act, but of course, the Joint Committee on Taxation Conference says this will affect over 10% of small business returns. And this goes into effect starting with 2018. So it will not affect the 17 return, it will affect the 18 returns, which will be prepared starting next year. How does this work? Now, who can take advantage of this? Anyone on this list, an S corporate partnership, a Schedule C, Schedule E, Schedule F, real estate trusts, REITs, co-ops, they can all take advantage of this. What is not on this list? Anyone care to guess? Anyone care to guess? Well, C Corps cannot take this deduction. But all these other entities, because remember, all these other entities are pass-through entities to the individual taxpayer. The C Corp is not. So, why are we interested in this deduction? It's not a credit. It's not used to arrive at your business taxable income or your adjusted gross income on your personal return. It arrives at your taxable ordinary income. When you go home, look at your return. Who here has capital gains, qualified dividends on their personal income tax returns? Okay, well,
I don't know if it's a C Corp, so it doesn't.
no, but on your personal return, you take dividends, right? You report dividend income. You have qualified dividend income. You buy and sell stocks. You have capital gains.
Oh, real estate.
Okay, well, even with real estate, still capital gains.
Right.
The way, remember, capital gains are taxed differently than taxable ordinary income. Once you determine what your capital gains and your qualified dividends are, and you have your taxable income, you subtract those from your taxable income. What's left, because remember, they get taxed at a different rate. Whatever's left over gets taxed at whatever tax bracket you fall into. The capital gains are taxed at 15 or 20% depending on your bracket. This is very similar. You're going to have your taxable income, you'll have your qualified business income, you'll subtract it out from your taxable income because it gets taxed also differently. This gets taxed at 20%. So this saves people money who are taxed at the highest rates, supposedly. Again, this is something especially that we're waiting for the IRS to come out with the regulations, and we'll see what happens. We're still waiting to see on this. Probably by summer, the IRS will have draft versions of the tax return forms for filing season 2019, and we'll know something more then. Okay? Now, when it comes to this, there are basically 3 brackets or bands. And we see here the first band is for marrying filing joint is up to $315,000, and for a single individual, it's half of that of $157,500. The second band is from $315,000 to $415,000 for a married couple filing jointly, and the last band is over $415,000. Now there are some nuances with the Section 199A deduction, and quite frankly, you are better off with this if you're in the first band. And we're going to show you why in a minute here. Now, some business owners are going to be disallowed from taking this deduction. Who are these owners? Well, it's basically white-collar professionals. Doctors, attorneys, CPAs, actuarials, any trade or business where the principal asset of that trade or the business is based on the reputation or skill of one employee or more.
That's kind of vague.
No, if you have your own business and your reputation, you get a lot of business based on your reputation and your reputation alone.
That's me, baby.
Yep, you have the potential of being affected by this. Okay, but this also, it's not just white collar people. It can also be other collars, performing artists, athletes, brokerage services. Again, any trade or business where it relies on the reputation of a particular employee or an owner. So what happens to me? Well, here's what goes on. First, now, first of all, it's very important to know that engineers and architects are excluded from this. But there are even limitations for them, because first of all, why are they excluded? Because they had an exclusion under Section 199, which is what 199A replaces. However, their exclusions have to be specifically related for an engineer to a construction project. For an architect, they have to be architecting, whatever the heck that means. I don't know.
Construction.
That could be.
Well, designing.
Mm-hmm.
Designing.
He made
Are-
the word.
Yeah.
He wrote it out there.
Okay.
That's what I used to do.
And like I said, these professions are carved out because they are losing the deduction they had under the old Section 199. Now, why do we need to be concerned? Now, here's the golden rule. Here's the thing. If you're back in that first band, remember, 157.5 if you're single, 315 if you're married filing jointly, it doesn't matter what you do, you will get to take this deduction. Period. Doesn't matter. Once you get past that, there are a whole variety, there are different formulas depending on the individual situation. And you may lose part of it, you may lose all of it depending on the income. So a person, a married single individual who has a couple $1 million of income, they're going to lose this if they were eligible. They're not going to have this. It's going to be, or they're going to have very low. There are multiple ways of this being calculated. So in this case, Congress hates the people who are doing well.
I don't know.
Unless they're paying them.
That's right.
Oh, but we have to remember, political donations are non-deductible anyway, so it doesn't matter. And that pretty much covers this. Now, this is just a general overview of everything that was of what happened in the tax bill. There is a lot more information. There is a lot to be still being digested. There are still articles coming out about everything. I mean, a client of mine up in New York who's a dentist is sending me an article that somebody wrote in a dental journal about Section 199A. What he told me from just listening to him, that the author of this article has already made some omissions regarding it. So we're still getting our head around, especially this part. But what you need to do is when you have your taxes done this year, talk with your preparer, see if they have any information or insight as to what your potential situation might be next year. I know that for my clients, I can at least take a look at what their potential situation is for next year, assuming that the facts and circumstances for 17 are going to be identical in 18. But of course, we know that one year will change from the other. The one thing that I can tell you, recommend to you, stress to you, is that during the year, if you see that there is a change in your income, especially up, even down, do not wait until now to go see whoever's preparing your tax return. Talk to them during the year, because things can be done, but they have to be done before the end of the year. Once we get into 2019, there's nothing that can be done for 2018. If there's any planning that has to be done, you have to do it in 18. For example, let's say all you do is an IRA. If you're over 50, it's $5,500, $6,500 if you're over 50 for the catch-up. Let's say your
What is
business,
that catch-up thing again?
if you're over 50, you're allowed to put an extra $1,000 into an IRA account.
Just 1,000.
Just 1,000. But remember, an IRA is the basic plan. If you're
Is that Roth IRA?
traditional or Roth,
Both.
either or a combination, but the max you can put in is $5,000, $5,500 if you're under 50, age 50, $6,500 once you're over 50. But remember, that is the basic plan. If your business is doing well, you may decide, well, maybe this is the year you start doing something more, because there are other plans out there where you can put away more money. There are plans where you can put away up to 25% of your salary or profit, up to about $240,000, I believe. It's depending on the plan. You can also do a defined benefit plan where you could put away even more. Also be aware that with some of these plans, if you have employees and they meet certain criteria, they have to be included in these retirement plans as well. It's not, you can't just do it for you. You have to do something for these employees if they qualify. But it's something you talk about with whoever is reviewing your work, whoever's preparing your business return, your personal return. Do not just think of a CPA as a once-a-year visit, whether it's you're doing, even if you have your own business and you're doing everything yourself, and at the end of the year you just bring everything on a flash drive and they do it. Talk with them during the year. Let them review it. Let them see what's going on. Take the differences. Talk to them. We're not here to give you bad news. We want to give you good news. We want to tell you you're doing well. You can do more than what you're doing now. Yes.
What about when you sell a house? Is there capital gains over?
The rules have still changed. Have not changed. They were talking about changing the exclusion. Remember, it's a $250,000 exclusion per individual, $500,000 for a couple married couple.
Mm-hmm.
They were talking about changing it from being your primary residence from 2 of the previous 5 years to 5 of the previous 8. But that did not happen. It is still the 2 of the previous 5. And as far as I know, the other circumstances where you could get a prorated, if it's less than 2 of 5, for example, a divorce and so forth, those are still standing.
Okay.
Yes.
If somebody doesn't have health insurance or Obamacare, you get fined.
Okay, yes, they did away with the individual mandate. Next year, if you don't have health insurance, remember, if you don't have the health insurance, there is a penalty of up to $695 or 2.5% of your adjusted gross income, whichever is greater. Whichever is greater. They did repeal that, but that does not take effect until 2019. It is still in effect for this year. So on your 18 return, if you don't have health insurance, you're still going to get penalized.
But not in 2019.
Not in 19, under current law.
Gotcha.
Does anybody have any other questions? Well, then I thank you for your time, and if anyone has any questions, please feel free to speak with me afterwards.